It's easy to get lost in the excitement of the stock market rally and buy anything just to join the joyride. So today we'll take a pause and talk about finding real value for the long haul. I'm Edric Mendoza and you're watching On the Money. Our guest today is Vandermir, a chartered financial analyst and someone who has been investing for many years. Hi, Vandermir.
Hi, Edric.
Did I say that properly? Vandermir Say?
Yeah,
correct. Wonderful. Welcome to the show.
Thank you.
Yeah, so let's talk about value investing. I hear it is a strategy employed by Warren Buffett and taught to him by his mentor, Benjamin Graham, right? But it's not widely practiced, I hear, in the Philippine market. Why?
Well, the reality is it's not widely practiced in most markets.
Really?
Perhaps because it entails, one, to analyze a lot of annual reports. And from the Philippine perspective, when you go out and ask participants in the market if they read annual reports, most of them will tell you they don't.
Okay, so why is it important? Maybe you can tell us.
Well, reading annual reports is just like probably taking a blood test. If you really want to look at someone's health, you got to look into the person's body and look at the records and the numbers to see how he's doing.
Not just the externals, right?
Yes.
Okay.
Yes, and so if you're not digging into a company or the business, the numbers, the figures, whether it has debt or not, it's hard to tell whether the business is good or not.
Isn't this something that therefore is suited for long-term investors, it seems like?
As value investors, I think we see it only one way. It's long-term investing, because I don't think you could call a one-year trading or 6-month trading play as investing.
Okay. And tell me how that is a good thing. I mean, if you're saying 1 or 6 months is maybe too short, what would be long-term and how is that advantageous, especially from a value investor's perspective?
We look at the 5 to 10-year period. For short-term trading, the risks to that is most of us cannot tell where the market's going to be in 1 month,
Clearly.
2 months, 6 months.
We wish we had a crystal ball, right?
Exactly.
Okay.
So we know that we can't do that. So value investors don't try to do something we believe we can.
Okay.
So then we look at the longer term period. One of the sayings of the value investors is, in the short term, the market is a voting machine. In the long term, it's a weighing machine.
I like that. Can you expound on that? That sounds interesting. Okay. The short-term voting. Okay.
It's voting. So it's just more buyers or more sellers. So if there are more buyers, the market goes up. More sellers, the market goes down. We don't play that game. In the long run, it's a weighing machine. It's going to depend on the business. Does a business have good value, good cash flows, sustainable business model, competitive advantages? Those are what last and what determine the value of the stock.
Okay.
In the long run.
Right. So essentially, it's really looking at the business viability.
Yes,
is what it is, right?
Yes.
Looking at all the indicators, etc. And therefore, if you see a good business, you will back it and just sit and stay with it for the long haul. Is that what value investing is about?
Yes, that is what it's about.
Okay. Do you have any other analogies that would help us cement this idea, especially since it seems like Filipinos, would you say, are short-term minded or long-term minded?
Well, in general, I don't think it's specific to a certain class of people.
Okay, yeah.
Because if you go around the world,
right,
the behavior is similar. Most people will not read annual reports. Most people would like to just look at the numbers,
right,
and look at
price,
one becoming 2, 2 becoming 4, and you're happy.
Right.
So the value investors are in the minority. And because I guess people try to look at the easier way of doing things. So if for analogies, I would look at probably like playing golf. I would probably be in the majority playing golf. I don't really learn it. I don't really practice it. But I'll go out on the golf course and disturb the good players.
Right.
So in investing, it's also like that. If you're not willing to do the homework,
you'll just disturb everybody else. I like that analogy. Okay, so you're looking at the markets, you're trying to find value. How exactly is that done, apart from looking at the annual reports? Is there any other way to find those that value?
Okay, if you would allow me, I'll go back to the basics.
Sure, I like basics.
Okay.
Good.
That's the only thing I know.
There you go, good.
Okay, so investing is basically putting off, like example, a peso today for a future stream of cash flows. So we sacrifice consumption today, let's say 1 peso, because we're expecting a future stream of positive cash flows in the future.
From that peso?
Yes.
Okay.
So that essentially is investing.
Sure.
So keeping that in mind, we all go out in the markets and try to achieve that. So how would you know what the cash flows of business is or will be? Essentially, the only way you're going to do that is by looking through the annual reports,
sure.
looking back. What is the history?
Hindsight is always 20/20, right?
Yeah.
Okay.
But when you look back, example, you can see likes of PLDT, Meralco, you can see the income figures they have done for the past 10 years. These will be very good indicators of how they're going to perform in the future. And also as value investors, we're not trying to predict the future because we know we can't predict the future. We don't know who's going to be the best tech player, what will the new technologies be,
sure.
which company is going to find oil, strike gold. We don't look and try to guess things that we know we can't. And therefore, the historical background or track record of a business is very important.
Okay, and in that historical track record, are there key figures or data that you particularly will latch onto? Profitability, top line sales? Is there anything that you will make sure that is, for example, constantly going up when you do your research and you look back?
Well, one simple thing would be, let's say, net income. So if somebody just flips through the financials, you could easily see the net income. Looking at net income for the past 10 years gives
you a very good story.
Exactly. Yeah, it gives you a lot of information. If it's fluctuating wildly,
that also tells
it makes you question, like why is it fluctuating wildly? From the businesses we invest in, you would tend to see consistently positive net income for the past 10 years.
That's a good metric, okay.
And a slight growth every year.
Can there be minor fluctuations here and there?
Yes, yes.
But net growth, okay,
yes.
I understand.
It gives you the confidence that the business can roughly make this much money.
Sure.
Right? And again, no one has a crystal ball. So as value investors, we see the stream of cash flows, and then maybe we wait, perhaps, that the price of this business, you know, during the cycles, right, would drop significantly. If you have a bear market, everything drops. And we still remember this very good business, which did very well for the past 10 years, comes out to a very low and attractive price, and that's where we come in to accumulate shares.
That's good to know. Okay, so you're looking for things like that. Apart from net income, any other indicators?
We look at a lot of indicators.
Yeah.
I'm keeping it basic.
Of course,
because,
the key indicators. Yeah, there are a lot of things I can imagine.
We look at cash flows.
Cash flow as well.
We look at the balance sheet. In general, very good businesses are not highly leveraged.
Okay.
Okay. So, in that sense, if I give an example, we could look at a business that's worth 500,000 pesos. Okay. That's 100,000 shares. So it's 5 pesos a share. So that's A and B. So I can make you choose. The asset is 500,000 also, right? If you only look at 5 pesos a share, both look exactly the same to you. But if you flip through their annual report, one can have 5 million in debt, one can have 0.
That's the leverage you talked about. I see.
So if you just keep looking at the price, everything looks the same, right? And if you don't flip through it, one is highly leveraged, one is no leverage. So we would tend to go to the one with no leverage.
That makes a lot of sense. So those are the stories, basically, that you're able to uncover by looking at all these historical trends.
Exactly.
That's great. My question would be, so if this is so good, why aren't more and more people adapting this?
Very good question.
Yeah.
This was actually raised to Warren Buffett a number of times. And he said, through the decades, as Benjamin Graham
mentored him.
Yes, value investing, intelligent investing. He said through the decades, he sees it's still a minority that practice value investing or intelligent investing, and possibly it's human nature, right? And
Human nature.
And also passion.
That, yeah.
Passion.
I see.
Right? There'll be a few passionate about golf, passionate about tennis, and probably a few passionate about investing. But I play golf and tennis, or if you could call it that, you know. But we're passionate about investing. So we put in the work. We're happy reading through annual reports. The value investors I know, we love reading annual reports because every report you go through, you learn something.
Right.
It helps you.
I can see from what you've shared, yeah.
It helps you study about other businesses, you know, when you flip through other annual reports.
Okay, so I guess it's because some people are predisposed to it, and people just need to be educated that, hey, you know, this is actually a good form of looking at the market, right?
Yes.
That's what we're seeing here.
Yes.
All right. I'm going to have more questions for you because this is, for me, it's actually quite eye-opening. It seems so fundamental that you look back, see the story of the business, but not many people are getting into this, right? So we're going to have more questions for you right after this break. Stay tuned. On the Money, we'll be right back. Welcome back to On the Money. Let's check what Salve Duplito has for us in Salve Says.
I love a good meal. It gives you a chance to catch up with your friends and relax together. I've ordered Caesar salad, a pasta dish, and a smoothie. I'm gonna eat now because I'm so hungry. Unfortunately, there is no other way to say this. Eating out is expensive. So if you're looking for a way to plug budget loopholes, you have to figure out how often you dine out. Thank you.
Thank you, Mom.
This cost all of maybe 500 pesos, a meal that I can easily replicate at home. To make your smoothie, you have slices of apple and banana and crushed ice. For the salad, we have lettuce, the dressing, and some croutons, and you toss it all up. And then for the pasta, you have fettuccine, some cream, bacon, cheese, garlic, and onion. And for all of these, it will only cost 150 pesos. Okay, so to make the smoothie, let's put the apples and the bananas, some sugar, and more sugar, and some water, and blend it all up. This is going to be so yummy. And some crushed ice. Ooh. All right. There you go. Yummy. All in all, a meal that can cost half or less than half of your restaurant bill. I'm not saying you shouldn't dine out. Enjoy the life that you deserve. Nothing removes stress as much as a well-cooked meal with good conversation in a great restaurant. But if you're on a tight budget, recreate these meals and you can save a lot of money.
Still with us is Vandermir, a chartered financial analyst and someone who has been investing for many years. And of course, Melissa Gecolea with your money questions. Hi, Mel.
Hi, Edric. Hello, Vandermir.
Hi, Mel.
Great discussion, actually. Great
Very
topic.
interesting perspective, right?
And I wanted to ask you, are there certain characteristics that you should look for in companies that might identify them as a value stock or a value company?
One important trait we look for is the certainty of income and the cash flows. So we're not here to guess whether we will make a lot of money or whether business will make breakthroughs or new businesses or new lines in the future. We are very comfortable and we want the certainty of cash flows. So we look at the past historical records to show us what they have done, and from there we understand what the business can offer in the future without any new breakthroughs or anything like that.
Okay, so it's not about futures, it's about past.
Exactly, yeah.
Well,
it'll determine, it'll help predict, yeah. Or
Okay.
not help predict, but help
Are
guide.
companies like utility companies generally good bets for things like this? Because that's something you'll always need.
A utility can fit the model if the price depreciates a lot. Example,
Okay.
if, to simplify things, if Meralco makes 100 million a year, right? And because we have a severe bear market, in 1 year, the market cap or the worth of the whole business comes out to 100 million, then it's a good buy. We would be very
Right.
attracted to the stock.
Okay. Okay, I get it. I actually have more questions for you, but I have to ask the viewer questions first. Now, Dan, via email, asks, I finally decided to invest in stocks this year. What's the historical return of the stock market in the last 5 to 10 years? Does this mean we will get the same return in the next 5 to 10 years?
I'm not so sure about the past 10 years, but the 5 years, I did look it up. It's about 113% for the PSE index.
Right.
So that means that for the past 5 years, if you have been investing, you should have at least doubled your money. Because being
fantastic.
passive, you would have doubled.
Yeah.
You would have doubled. And to his next question about the next 5 to 10 years, sadly, my answer is I don't know.
Okay.
We wish we had that crystal ball.
Yeah, so value investing really is not about like guessing what the future will be.
Yes.
And in this case, yeah, you just, what is your, I mean, I know you say you don't know, but what do you think might happen in the next 5 to 10 years?
Well, I would look back at the statement of a wise value investor who said, you know, if you want to keep things really simple, you could simply be greedy when others are fearful and fearful when others are greedy.
Yes.
It looks like we've been a little more greedy in the past.
So it's
5
good to be
years.
fearful right now.
Well,
I just saw on the news earlier that we're overpriced.
Time to be fearful.
So,
we're
Is that what you're
probably
saying?
not
Yeah.
that cheap.
Right.
We're probably not that cheap now.
okay, great. Well, we'll go to the next question from Michael Kenneth A. Desierto via Facebook, who says, I started investing in UITFs and in the Philippine Stock Index Fund late last year. How long should I keep my money invested to enjoy maximum yields from those instruments? Is it also wise to invest in equities now when the stock market is in its glory days? Or should I wait for the stock market to go down a bit? And how much money should I invest, the least amount, to enjoy better gains? Thank you. Oh, that's part of his question, reading the whole thing.
One good discipline would be to regularly invest in equities.
Okay.
Because it is the asset class that would give the highest returns
Okay.
in the long run. I mean, you've got cash, you've got bonds, and equities always outperforms them when you look at a 10, 15, 20-year time period.
Okay.
So if you have this many questions, that you probably are not reading annual reports and you're probably not doing so much research. So maybe a discipline of buying regularly, buying
Okay.
stocks regularly would be a good idea. And if you could join in that saying, right, being greedy when others are fearful, that would also help you in the long run.
Okay, so he should buy regularly regardless of where the index is. So even though it's high right now, you're saying go ahead, buy this month, buy again next month, buy every month, and don't wait for the correction or...
Well, ideally, one waits for the correction or the better valuations.
Yes.
But in reality, for the average investor, when it is the best time to invest, they're not going to invest. Because that's when
Right.
everybody's running in the streets and
Sure.
what they call blood is on the streets.
Of course. Do you think there will be a correction soon?
Oh, there definitely will be a
Okay.
correction. We just don't know when.
Okay, what's your prediction for this?
I don't know.
Nice one, Mel. Crystal ball.
I'm
Let's
trying.
hear this. Let's hear this.
No prediction. Sorry.
Okay, I was just curious.
Yeah.
Okay, now Rolando Jose via Facebook asks, I've read books about Robert Kiyosaki, and he is saying that over time, mutual fund companies take 80% of the fund's earnings, while the investor is taking 100% of the risk. Is this true?
I don't believe it's true. I mean, funds charge a percentage or two per annum.
Right.
So in general, they'll take that much per year, and not something like 80%.
Is the U.S. good right now, considering everything's down? This is the time everyone's running.
The U.S. is becoming attractive, yeah, because the economy is picking up. It's clear that it's picking up, and there are attractive targets in the U.S.
Okay, what about Europe?
Europe also is interesting, since they had a crisis and they seem to be managing that well, and there would be some interesting bets there.
Okay.
Okay.
So those are good ideas if you're
Right.
thinking of value investing. Okay, our next question comes from Alan Miranda via Facebook, who says, which is a better investment choice, buying a pre-selling property of a reputable real estate company or buying the stock or share of the same company?
Okay. Always it would depend on the market cap of this company that he talks about. What is the market cap, which is the price or the market price of the business, and you look at it relative to its value. So that's important. He's got to look at those two figures and compare them before he can answer this question.
Okay, so once he has that answer, then he'll know.
Yes.
Okay. Wow, a lot of research is really involved if you want to be
go
a
value
smart
investing.
investor.
Yeah.
Yeah.
Especially this route, right?
Yes, especially
what
this-
I'm gathering,
this
though,
route.
I mean, in Alan's question as well, Vandermir, do you think it would help if he determined what his immediate goal financially
what his
would
need
be?
was too.
Right? Because pre-selling a property or buying a stock, I think will have different time frames. If he buys one now and he's able to rent that out, he could get returns, whereas the stock would be longer. Is that a factor for?
And there's management,
Yeah.
management fees, things
Yeah.
like that.
Okay. There is more upside if you buy a stock.
There's
I
more
believe,
upside.
right? So if you buy the stock at the right time, the right price, there's much more upside there. You'd also have to match it with the temperament. And talk about temperament.
How much
When-
risk, etc.
When Warren Buffett was asked, what is the single most important characteristic of
I like
a
this.
very good investor?
Okay.
It was temperament. It wasn't even intelligence.
So stay
Temperament.
cool.
Yeah.
Stay cool. So that was good for me because I have a very low IQ.
So stay cool, right?
Well, it's I guess it's also inborn, right? It's natural. So by that I mean there are actually very good property investments by some people I know, but they had to hold those properties for like 10, 20 years, and the price appreciation is massive, right? But if you have a certain temperament, maybe if you made 50%, you sell your property. You know what I mean?
I see.
The difference may not be that big, whether you buy the share or the stock, if you're going to unload anyway if you make 50%. When you talk about massive income from property investments, I'm talking 3, 10, 20 times.
Wow.
Right? I mean,
Okay,
From
that's
property
serious
investments.
investing then. Yeah, that's not just I want a quick turnover, but I want to make this much. So you have to kind of think bigger.
we tend not to like quick things, quick turnovers, overnight money, because we tend to believe they're not sustainable.
Of course.
And the risk is very high. Because you come closer to maybe scams, right? If you're tempted to make 100% within 6 months, somebody guarantees you that or says you can do that. You come closer to the mentality of investment scams.
Yes. Okay, well, Danelle asks from Twitter, she says, can you recommend books on picking stocks? Do you advise going to free seminars? I don't want to waste time.
When I was much younger, I attended free seminars simply because I was passionate about investing. So books, I would read all the books. anyone willing to talk about investments, I would listen. And from there, you would form your own conclusions and beliefs as to what's the best way to invest. For books, we talk about Intelligent Investor, anything about Warren Buffett,
Yes.
Charles Munger. These are books we read.
Okay. And how much did they help you? Which was the most useful book to you, would you say?
Well, Intelligent Investor was very useful. I don't think we have much time, but
that's fine.
There were three words there. Margin of safety. So they said, you know, everybody likes to learn about investments, right? But everyone has no time.
That's right.
We don't have time to read annual reports. We don't have time to look at anything. Just tell me how to make money, right?
Quick.
Right, tomorrow. It's not that easy. So when people very quick want to have, you know, a short lesson, we use the words margin of safety. This was from Benjamin Graham.
Okay.
He talks about businesses. Let's say if a business is worth 100 million pesos, right? We don't want to buy it at 100 million because there's so much uncertainty in the world. All of us are open to that. No one has a crystal ball. So we start buying in probably at 30-40% discount from that valuation we have. That would help a lot of people because then you would tend to buy at the right prices.
Okay, I see. So you don't just invest your money, you're investing your time.
Oh, yes.
Okay, anyway, send us your money questions via email or through Facebook and Twitter, and we'll try to answer them in our upcoming episodes or on our next Q&A Friday.
All right, I like this idea of value investing, looking at good value and then just going the distance, right? Temperament. I like that. Yeah. Vandermir, Mel, that's our show today. I'm Edric Mendoza. Join us again tomorrow for more talk and tips so you're always right on the money.